All right, so we're going to try valuing Decker. So I'll put the ticker in and we're going to go out and do Decker and do function 8 for equity and then do the supply chain management 8 SPLC. And we'll click over on competitors. And we'll find some competitors for Decker. It's a sports outlet. Let's do it by, yeah, Nike, maybe. We'll see. Columbia Sportswear actually is a good one to do. So COLM. COLM. And let's find one more.
Can we do Puma?
Yeah, they're more, I'm trying to avoid the pure shoe stores, but I guess that's all right. Decker is more of a retail outlet, but
Shirts,
we can try it. Puma is not a US company though, so that wouldn't be good. Um, American Sports, AMER. Let's try that one. AMER, and then let's find some competitors. I'm not exactly sure what industry they're in. Consumer. Let's look under retail. Consumers communication. Let's see where they actually are. So one thing we can do to try to find out what index they are, you can do Ray and do members, and we'll find Decker. And so that will bring up all the stocks in Russell 3000, and we can actually ask it for its industry. And so we'll find Decker. There it is, outdoor. And we're going to add in the GICs. Let's try sub-industry name just to see if it's there. And the sub-industry name is footwear. That's probably too restrictive. Let's try GICs again. Let's do industry group name and try that. And that is consumer durables and apparel. That's one we can certainly try. Consumer durables and consumer durables. So let's sort by, and you watch this. So I'm going to sort it by industry group. And we'll find consumer durables. And when you right click it, it should give you the ticker, but it's not doing that. So we got to find the ticker for this consumer durables and apparel. S5 consumer. Let's try apparel. Apparel. Let's try the S5 APRE. S5 APRE. So we got the industry there. So there's Deckers, one competitor, two competitors in the industry. So you can see I've got a few of the industries loaded here, but you can see you can go in and get a little more detailed on the competitors. All right, so the first thing I'm going to do is the beta. I'm going to go to the rolling beta. I'm going to have Bloomberg update. Have Bloomberg update. If you have a Bloomberg account, you want this file and you don't have it, email me and I can send it to you. So here we got the data loading in, but you can see their data doesn't start until way back here. So we'll load this one, 10/29/93, where it started. And that will update the data. So you can see, we expect this to be a beta above 1. You can see if you look back at it, it's actually, its median's slightly below, and the industry is like right at 1. I had trouble saying, I mean, it is shoes. People tend to buy shoes in a recession, but not at the same high level. So when we go to the discount rate, so we did the rolling beta first, you can look at the graph and see if there's anything that stands out there. And one thing you notice is they had a period of time where they're very, very negative. The last few years, they've been consistently a beta between 0.75 and 1. So they do have an actually pretty low beta. So let's try, I'm going to do 0.9 for the base, 0.75 for the bull, and 1.25 for the bear because I have trouble saying this is going to be a below 1 beta stock. It just doesn't make sense. Their debt's not particularly high. Their margin's not particularly volatile. So I'm not going to adjust it for debt or operating leverage. So now we got a discount rate. So the next thing we'll do is DCF valuation. So really, really strong growth the last several years. This firm has grown really fast. They don't pay dividends. They don't have a PEG ratio. Their implied growth is 40% from the ROE. But what we want to do is go into Decker and Bloomberg and type Decker, F8, and EE. And we'll get the earnings estimate. We'll change it to annuals. And look at that growth, my word. Just really, really strong growth. So the market loves, the sell side loves this company, 8616. So 8.616. And the latest EPS was that orange one, 633. And that gives you a growth of 8%. So we'll use that as our base case. The bull case, their growth has been spectacular. If you look back, it's been really spectacular. So you could make an argument for higher growth for this firm. So maybe we do 15, and for the low end, maybe we do 6. How long is it going to take to get from there to there? Well, they're showing them going out pretty strong growth. I keep looking at Walmart's. You can bring in their actual chart here. And sorry, I forgot how you did the snip, so I'll have to do it again. You can bring those charts in just so you can show that the growth is consistently considered to be strong, just going forward. Oops. So I'll put that picture under this just so we have it. So, I'm going to go out 5 years, maybe 3 years. So, all right. Then we got to pick. It's important that we pick which cash flow we're going to use. You can see here, they don't pay dividends, so we can't use dividends. They have the 2 free cash flows. The reason I have 2 of them here is there's a slight difference in the timing. One of them is trailing 12 months. The other one is the last fiscal year. You can see they're very similar, so we'll just stick with what we have. And when we do that, we get pretty good valuations. So if you look at the football chart, we've already got 2 pretty decent football charts up there. All right, so now let's do relative value analysis. So you can go back to the overview, click on relative value, go to the next sheet. We'll refresh this workbook here. We're not getting good data back that far, so we'll have to change the date here. Let's see when their data starts. Looks like 3/31/94, so I'm going to copy that date and paste it here, and then refresh the workbook. And I'll cut this out of the video. All right, so we got some pretty decent data. We're going to copy all of that. And we're going to paste it to the next page. And then on the next page, on the next page, we want to go down to the bottom and just make sure you got all the latest data, and it looks like we do. It looks pretty good. I copied it down pretty far, so yeah, it's coming through the most current month and day through, we're doing this February 11th, so it has that, so that's good. Then we go to the analysis. We'll use EV to sales. That makes sense. And we'll look at them versus their industry. Here's their EV to sales chart. They look relatively cheap, right? They're kind of down at the bottom of their range. So we'll use that. And so based on that, we now have our football chart. We now have the relative value, pretty wide range, right? If you don't like that wide of a range, you can go back to the relative value model. And if you want to, you can do the 20th percentile instead of the 10th percentile. And we'll update that, and that'll make that range not quite so wild. And then we go back to the overview, look at the football chart. It changed it a little bit, but not dramatically. And then the last one we have is the capital IQ model. Here's the bull case. How big is this company? Do we need to add a size premium? So we'll look at description. And their market cap, 16 billion. Probably don't need to add anything for size, but if you have a small company, you can add 1% there. The only other thing to do is look down at the forecast, see if anything unusual going on with the forecast. You look at that revenue forecast, that looks reasonable. Here again, you can use Bloomberg as somewhat of a help. Remember, we use the EE function. And you can do annual numbers. And we can look at revenue and we can see what Bloomberg says revenue is going to be. So Bloomberg says for 2029, it's 6,558. 2029, we have 7,582. So we're a little bit high, but that's our bull case. If we look at our bear case, 2029. So we're right there between, right there. Our bull case is higher than the market. And our bear case is below. So that makes sense. We got some good numbers there. If we look at EBITDA in 2029, again, we can use Bloomberg as somewhat of a test. Look at EBITDA. And their 2029 shows 1,386. Ours shows 1,905 for the bull and 1,4. So we're a little bit high on our EBITDA margin. You can notice that their margins have been declining from 49 down to 42. So the 42 to me seems reasonable, given that it's kind of the lowest number of the last 5 years. Are they going to continue declining? Who knows? But that's our bear case. Our bull case is going to be, the same margin. But that seems reasonable. Everything else is in there, so all we got to do is go look at the results. And here's our football chart. Here's the current stock price. Right here. Does that look like a buy, sell, or hold? It looks like a pretty strong buy, right? So it's currently trading for 115. And we have it, and it's 52-week. It's right in the middle of its 50. It's not like it's trading that's, an unusual high level. And it looks, maybe I would say we can hold on to the stock. I feel comfortable holding on to it based on what we have here. Our assumptions don't look radically off. The one thing that bothers me a little bit is the discount rate. So I would normally think of this as a 1.15 kind of company. If we do that, how does it affect the football chart? Brought it down some, but it's still, so I was a little bit worried about the beta, but it doesn't look that bad. All right. So let's save this. How long did that take us? I don't know, but we have it. We have the video now, so here. So we'll save that. I'll close. Let me do this. Let's do one more. All right. Now we can do one from our portfolio. So one thing we could do here is keep track. Insert comment. Where is it? New comment. Bin and suite value. Oh, when we do it, we did it last Wednesday, right? So Feb 4, 2026. And then now we just did Decker. Insert comment. Valued Feb 11, 2026. So we can just keep track that we're updating these stocks. So do y'all have a stock you want to value? You want to value one of the ones in this list? Anyone have one in particular they're interested in?
United Healthcare. Arrowhead. Oh.
Arrowhead? All right, you don't want to value one of yours, Nicholas?
They can go ahead.
All right. All right, we can value a firm. So which one are we going to do?
You can do first, United. Oh. We can do.
United Health.
Finances. Screen the bottom, make sure it's a good one.
United Health is a tough firm to value, but we can try it. I think it's UNH, but
What was wrong with this scores?
United Health Group, UNH. We'll find the competitors, which is going to be tough because this is a very unique firm. So SPLC, click on competitors. Cigna makes sense. I can see that. And they're probably the second biggest one out there anyway. There's not a lot of choices, are there? So Cigna, CI. And then who else? That other one doesn't look like a US company, is it? It is ELV. It's a big company too, man. It's amazing. ELV. This is an industry as we heard last night is a lot of consolidation. All right, let's see where we can bring them in here. This is healthcare services, right? More than anything else. I don't have healthcare services. We'll just try healthcare. Let's see if we can find healthcare services. S5 health, healthcare sector, equipment, services. Yeah, I don't know what the ticker is on services, so we'll just leave it there, but and just use healthcare. So that one's you do the workbook S5 HL, and I can't see it. Yeah, the machine is definitely acting up. HLTH S5HL. Any questions how I'm getting the tickers? There's several ways to try to find a good ticker for your firm. You don't want to get too far down. If you find it you're so specific, like here, we could get real specific. United Health, but there's only 3 companies there. We want a bigger group than that, so that would be a little too precise. So we'll do healthcare. I would do healthcare services if I could find that actual ticker. That's a much bigger group, but at least we have that. All right, y'all remember where do we go first?
Discount.
Which part of the discount?
Rolling.
Rolling beta. Let's start there. We'll do a refresh. You shouldn't normally have to do refresh like this, but there's something strange going on with this machine. So let's see, looks like 1231.90 is not a bad place to start. ELV doesn't have the data, but that's okay. It'll just be out of there. Healthcare, you would think I would have a low beta, and sure enough, these firms do have low betas, so that kind of makes sense. You might think with healthcare services that they may not do well in recession because people lose their jobs, so they lose their employer healthcare, but most of this is being paid for by whom? By government, Medicare, right? So that one is pretty recession proof. So that's probably not a bad beta. So if we come down to our beta, yeah, 0.5 might be a little bit low, but 0.6 wouldn't be bad. 0.5 here, maybe 0.75. That makes sense. Healthcare can be a pretty low beta. So I'm comfortable with those numbers. They're saying that their leverage is really low. Their operating leverage is really low, so that maybe gives them a subtraction. But I'm not going to make that adjustment. I'm going to leave it a little bit on the higher end, but that's fine. All right, where do we go after we get the beta? So go to DCF valuation, and we got to look at growth rates. All right.
Okay.
So let's do the refresh. They do have a PEG ratio, so we can use that to help. The PEG ratio is essentially real similar to what we're doing over here. It's just another way of saying what do analysts think their growth is going to be over the next 5 years. It's just another source. You can see, obviously, United Health has really struggled. They've had that tragedy where their CEO was assassinated. They've been under investigation by Congress. So it hasn't been good growth rates. Over the long term, growth rate's been strong, and they are expecting strong growth going forward. Let's try this with how would I find the growth rate here? EE, earnings estimates, change it to annual. Yeah, look at that. The growth just nosedive, but they're expecting to come back not as high as they had back here. It's still pretty good growth off their low, 28, 567. And then off of a base of, look at the lattice, 16 through 35. We'll refresh that. Wow, they're expecting strong growth, but strong growth off of a pretty good low point based off their history. Let's take a picture of that just so we can see, have a good understanding what's going on. Sometimes I'll put the revenue growth in there, and you can do that. I'm not going to do it here just to save time. But the picture tells you quite a bit. You say, wow, that's really strong growth. Well, but they're still below where they were in 2024. So it's not as strong as it looks. So we're getting some pretty strong growth. This number is a historical one. Remember, historically, they're coming off a really low base, so I wouldn't trust that one as much. You can see that just like we heard last night from Tyler, you definitely can use earnings estimates from Mark from the street, and that's what these two numbers are. Let's kind of split the difference, and let's try 12, 15, and maybe 7. They're going out. The next 5 years is pretty strong, so I'm going to keep that there. I know some of this is somewhat subjective, but those are reasonable numbers. So let's refresh the workbook. And then the next thing is we got to find the cash flow that we want to use. The free cash flow, we can use free cash flow for United Health. You can't really use it for insurance companies, but they're much more than an insurance company. They have hospitals and all kinds of stuff. If they were purely an insurance company, I would probably just use their dividend. So if I was doing a bank, I would only use the dividend. In fact, banks don't have free cash flow, so I'm going to use that. Boy, that's giving us a massive valuation. That may make us a little nervous that it's just so strong. We do know that, I mean, look at the 52-week high. That's not that far off from our base. So what in our assumptions do you think is giving them too high of a valuation?
It's the low point.
So remember, your first question shouldn't be what did we do wrong? That's the wrong question.
What do we do right?
No, your first question is where do we disagree with the market? It could be you disagree because you're wrong. But don't start off with what I do wrong. Start off with where do we disagree with the market? We're using the market on growth. So it kind of leaves you with, are we using the right valuation? So this might be one I'm a little bit leery using free cash flow here. Given our valuations are so stretched, let's try dividends, given that there is an insurance element to this, and that will certainly, if they look valuable using dividends, I think we've got some confidence that this is a stock that's interesting. That gives us much more reasonable valuations. So and I don't know how much of their business is insurance. So you can't use free cash flow for insurance. It's just insurance and banks don't have free cash flow. The term doesn't make sense for them. Because when they get a cash flow in, if you think about a bank, it's a cash flow in. It's not an operating cash flow. It's really more like debt. It's really more like risk. They're taking on risk. If you buy auto insurance, yeah, it's revenue for them, but they're going to pay you out in claims in the future, and it looks more like debt than it looks like an operating cash flow. If you go buy something at Walmart, they're not going to pay you out cash over the next 3 years. So their actual revenue almost looks more like debt than it does revenue. So you got to be a little careful. United Health is a little different. If it's a hospital, you can use free cash flow. If it's insurance, you can't. I just don't know how much of their business is insurance. So we'll play it on the safe side and use the dividend for them. And that seems like that's given us more reasonable. All right, where do we go next?
So what's dividends? How do we calculate that?
That's their historical dividend that's paid per share.
Okay,
So that's just history. Yeah.
what they've been paying shareholders.
Yeah, they've been paying a pretty decent dividend.
$8
All right, so where do we go next?
$8 per share, that's pretty good.
So we'll go to the relative value model and let's refresh it. Now, what would we use for United Health, do you think? Probably going to use, if it's insurance at all, you're probably going to use price to book.
First,
So it just makes the most sense. So we'll bring that over, copy it, paste it over here so we have the values. Got to keep updating Bloomberg. Then we look at the analysis and we'll change it. And this is the part of the spreadsheet I fixed so you actually can use price to book now. It used to be the Cap IQ didn't work with price to book, but this one does. So here is their price to book. It actually looks pretty reasonable, and they do look pretty cheap on a price to book. You can see how far off it is versus kind of the average. So they're probably going to look pretty cheap on a price to book basis. See if we can get rid of these lines. So if you look at it on a price to book basis, their current price is 268, but their range is from 200 to 718. So they're on the cheaper side of the range. All right, where do we go next? Capital IQ. It's a huge firm, no reason to adjust for the size of the firm. Let's come down on revenues. We're showing $805 billion. That may be a little high. Let's look at revenue here. They're showing the right firm. Annuals. Wow. They're showing 0.5 billion. We're showing 0.8 billion. So that's pretty high there. We may need to pull back some on that because we're using earnings growth for our revenue growth. So I'm going to pull back some on that. I might pull that back to 7 and then pull the bear case back to say 5. We'll see. That's kind of a flaw in this model is I'm assuming revenue and earnings grow at the same rate, but that's probably not that true. There we get 0.56. That looks pretty reasonable versus their 0.5. In the bear case, we get 0.5 as well. So that seems reasonable versus what the market is saying. So we can certainly go with that. And then let's look at their EBITDA. See how close we are on that. I'm not saying the market's right, but they're probably more familiar with these stocks than we are. And if we're going to get $800 million in revenue and they're expecting 500, that may be a little high. So 49 billion in EBITDA. And they're showing 37. So we're pretty aggressive on the EBITDA side. I may come off some on this margin because you can see it's higher here recently. Let's jump back to 75 on that. I don't know if anyone in the class is actually doing United Health, but we'll see.
Good analysis class?
Yeah. I mean, it's a massive player. We're gonna have someone from United Health speaking to the class on Thursday. It's still pretty aggressive, 37. We're showing, I don't know if it updated or not, but we're showing 49. So we're pretty aggressive. So we might get a little bit nervous on that. We'll see what the Capital IQ model shows. So let's go back and look at our football chart. So let's insert. Yeah, it looks pretty cheap, doesn't it? Investment banking model. We know we're pretty aggressive there, so that we may discount that model, but the other ones, the relative value is the relative value. All it says is where they trading today versus where they traded historically, and that's not against the S&P 500. It's against their peers, against other healthcare, and they're trading pretty cheap in that area. They look cheap on the dividend discount model. Remember there, we substituted dividends instead of free cash flow, and it brought our valuations way down. Even then, it looks pretty cheap. So this looks like this could be an interesting stock. You have to ask the question, though, of what was the market telling you with this? They haven't done much since. I'd rather buy it here than there, right? That's a huge drop. We're not talking 10%. That's going from 600 bucks. That's more than a 50% drop in just a year, less than a year. 50% drop. If you go back a little bit further, you can see it was on a tear up and then a massive drop down. We'll see on Thursday night when we talk to our United Healthcare. It's such a complicated firm, and we talked about that last night with Tyler. It's a very, very difficult firm to value because it is so complex. You're essentially trying to value multiple firms, so it's a little tough. But our valuation seems reasonable to me. I don't think there's anything we're particularly aggressive on. But this is a firm under investigation, actual criminal investigation. You know, if you look it up, you look up what's going on under federal investigation. That never sounds good, does it? This is pretty old, but is cooperating with federal crime and civil investigations. The healthcare giant said Thursday they had contact Department of Justice on reviewing meta reports about investigations of certain elements in his business. The Wall Street Journal said federal officials had launched a civil fraud investigation, how the company records diagnosis. You know, this has been an issue we talked about in my life insurance class. There's firms being accused of sending them bogus bills to Medicare, and that's not going to be good. And Medicare is a huge part of their business. So yeah, they're under investigation. It covers more than 8 million people. Largest provider of Medicare Advantage plans. So yeah, that's not good. Plus, they had their CEO was assassinated, which didn't cause the stock price to drop. The stock price dropped because of the investigations. If we throw in key events, you'll probably see some articles somewhere around in here. I'm surprised you don't see one there. Police arrest person interest. Yeah, that's the CEO right here. They don't have anything here. Let's see what the latest article says. Yeah, it's about the CEO. So you're not seeing anything related to the investigations. Let's look at their earnings. All right, so here's interesting. The stock dropped with positive earnings. So they beat on earnings.
How bad was their?
So they beat by 0.38 on earnings, on revenues. They missed slightly on revenues, but the stock dropped 19%. Their next earnings release is April 17th. Looks like pretty solid growth. Earnings per share has come off dramatically, right? Pretty dramatic drop in earnings per share, but that's a pretty big drop. The market's definitely telling us something is going on with this firm, and it should make us a little bit nervous. So they beat and still fell 19%, and there's no articles about them. So it looks cheap, but you got a lot of noise going on in the background and on a very complicated firm. This would be a dangerous firm, I think, to walk into with us not really understanding the business and understanding this business we have. We'll see. Devin talks tomorrow night. I think what he's going to prove it to us is that this is one incredibly complicated business where it actually almost competes with itself. They have firewalls up between different of their companies because they don't want to look like they're colluding because they're in businesses that should be competing. They shouldn't be colluding. You don't want PBMs colluding with insurance companies, all this kind of stuff. So it's a little dangerous. Sometimes you say, it looks cheap in our model, but can we really understand this firm well enough to jump in and actually buy it? These are the kind of firms I love that have gotten really cheap recently. They're trading at, a 50% discount to where they were a year ago. I like that idea, but it needs a business that I can understand enough to understand why the market is reacting so negatively. I'm not so sure on this one I can. All right, so I just went really fast. So now the thing is, those that are here, you've got to now figure out what we just did. So you need to get this model. I'm going to stop the recording because we don't really need that. All right, so y'all see the process, the discount rate. We might have time for one more real quick. The discount rate, we're using CAPM, which is the risk-free rate plus the market risk premium times beta. The risk-free rate is just a 10-year treasury, so you don't need to do anything there. You can use my market risk premium. That's pretty standard. So the only thing you have to do in a discount rate is come up with the beta. What we do on the beta is, this first line, you just type in what you think the stock is. I'm kind of ignoring that one. But we have the historical beta for the firm and competitors. That gives you pretty good insight on what you think the beta might be. Is that consistent what you think? So there you got the discount rate, in about 3 minutes. You have a pretty good discount rate. Then we go to DCF valuations. The key there is two things. First, what is a growth rate? We have two places where we're looking at what the market thinks. You have some historical growth. You have what the market thinks. And then we have what's a kind of a traditional approach, which is what does their history show about their growth? So we have two places with history. And then you just got to plug in your growth rates. Your long-term growth rates will probably be real similar to US economic growth. The short term and how long that short term is going to last, there's where you have to put your time. So you want to put a little time in there, but that gives you the DCF. You then go to the relative value model, and that's just a matter of updating the data and then looking at the output. Essentially what you're asking is, where are they trading today? Where are they trading today versus their history? You can see they look pretty cheap. Over here gives you a schedule that says their current price is $278. Based on their history, they should be trading at about $400. And their range, 10% to 90% range is 200 to 718. So they're trading at the low end of that range. Pretty simple analysis. What the charts help you with, because what you'll see sometimes is a firm who is way up here when they first started out and now they're more normal. So you might actually change your date. Like if you were way up here and then the last few years it's been here, you might change your start date to when they're more normal. So when you go back, and that just gives you more information. But this one looks pretty normal, right? And I don't see, it looks like they tend to trade in a pretty wide range between 0.2 0.2 and 1.8. That doesn't seem that unreasonable with the more recent history, so I don't see any reason to change the date. But if you do see something unusual, back here you can change that starting date so that you get past that. So Walmart's a good example. Walmart traded at a very, very different level when it first started out as a small company. You can definitely say, hey, ignore the 80s. I'm going to start this at whatever time, and you just change that. And then the last one, the capital IQ model, it's all set up to run. It uses your assumptions. The only key here is to go down to this forecast and maybe test it against what Bloomberg says. And y'all saw where we did that, right? Revenues and EBITDA, you can just use the EE function. And if you're way off, you might modify some of these blue numbers, the margin, the growth rates. You can do that and just, not that you're trying to match Wall Street, but just give some sense that maybe you're being too aggressive or too conservative. And when you finish all of that, you got your football chart. And what we're looking for is not firms that are cheaper than our models, but are on the low end of our model. They're trading to the left side. And you also kind of look at their 52-week average. If they're at the very, very, very top, you might get a little concerned. You can do an RSI on this firm.
It's RSI.
Relative strength, trying to see if, yeah, they're at a oversold level. So the market's telling you should have bought them right here. The market reacted too negatively. You oversold here, oversold. Look at that big gap. So they had a big gap when they released earnings. They had another big gap a few days ago. I'm not sure what hit there. Maybe some headline. It's kind of frustrating that the GP function is not getting us any news. Where else can we get news? But on Bloomberg. How about the word news and United Health?
Skill function.
Zip as it shrinks its business, healthcare. So we could read some of these articles and see if there's something really, really big we're missing on the firm. So that's not a bad way to find some information on the firm. All right. So y'all see the process. So we'll do this each week. We'll value some stocks. We really want to make sure Gerardo want to do one more. So I'll do one more real quick. So what did you want to do, Gerardo?
Region and REGN.
All right, so we're done, but if you want to watch one more. SLP. I can never remember the supply chain. SPLC. Let's look for some competitors. Make sure they're US competitors. Amgen, that's a great company. AMGN, I'm sorry. AMGN. Gilead's a good company, but we've owned both of those in our portfolio before. And what industry? This is pharmaceuticals?
No, bio.
Okay, so we do have bio set up. Those are some pretty big bio firms.
This is all the other ones are like pipelines.
Yeah, I mean, these are huge firms, so we'll get some pretty decent data on them. PHRM. All right, so let's go get the discount rate. Probably going to be a pretty low discount rate because this is healthcare. I should have changed. Let me bring up the old model so I don't have any. Any questions while we're running through these? Does it seem like it's just too simple? Too easy? But if you listen to Tyler last night, I mean, there was no magic bullet he was telling us about, and he's really good at this. He's been doing this for years. All right, so we look at the rolling beta. They're actually trading, Regions actually trading at a higher beta than their market. But if we look at the actual data, we can see if there's something strange going on with them. They've kind of been all over the place. So let's look at, we look at the industry. The industry is more point 0.6 to 0.9 range. So I'm going to use 0.6, 0.7, 0.6, 0.9 for our company. So we got a discount rate on valuation. Growth has been pretty anemic the last few years. The PEG ratio shows 8%. The recent history shows 13.65 based on the ROE. Let's look at their earnings estimate. Looks like they had a bad spell there after 2020, but have been flat since and now expected to come back somewhat. So really flat after a big drop, but now expected to grow. So we're going to get some pretty decent growth rates here. The out year is 66,309. That's a really big number, isn't it? They need to do a stock split. And the starting point was 44.31. So let's look at that growth. 10, man, they're expecting some pretty good growth. So we'll do 9, 10, and maybe 7. They're expecting that growth to be pretty constant the next 5 years. So I'm going to do 5 again. We don't have a dividend here. They don't pay a dividend, but they do have free cash flow, and it looks real similar between the two, so that's good. Or we're getting a big number, but I don't know what in our assumptions is going to cause that, other than maybe the beta being low. But you're getting a really big number. But that's fine. That's what we have.
You're not recording this, right?
I can't remember if I turned it off or not. No, yeah, I still am recording it. Yeah. I don't know if it'll be in my video or not, but
This one?
all right. So let's go to the relative value and see if we get something similar there. All right, it's not giving us numbers, probably because they have some negative numbers. Let's see what date we can change this to. We do want price to book, so we can use price to book. Starting there. Let's see if we can, how long until earnings comes in. Let's try it from here. I don't know this company as well, but I think it's a pretty good sized company, isn't it? Yeah, $82 billion company, so it's not a small player. All right, so we got our relative value. If you're not familiar with relative values, I have videos out there that walk through when to use price to earnings, when to use EV to EBITDA, when to use EV to sales, when to use price to book. So if you want to watch that video, I can give you a link to it. We've got our data. Look at the analysis. We're going to use price to book for them.
What EV to EBITDA then?
Huh?
What EV to EBITDA?
Well, it depends. If it's insurance, it's price to book. If it's healthcare services, pharma, if it's pharma with heavy research and development, price to book makes the most sense. If it's a hospital, you could get away with EV to EBITDA. Maybe you could try both. You can do both and look at them and see which one's more reasonable. You notice their EV to EBITDA is going to be pretty messed up.
EV to revenue.
You can see how messed up that chart is there. So PE ratio is pretty messed up. EV to sales is really for retail companies, not really for insurance. So price to book is a good one to use for this industry. You'll notice they're trading really cheap. Now, is this another stock that has sold off here recently? Actually, it's up pretty strong here recently, so it's not like it's trading at some all-time low. It's come off quite a bit since 2040. It doesn't look radically different at United Health other than it's had a good recovery here recently. So it's definitely trading at a lower level. This is showing that it's a pretty cheap stock. So if we look at, okay, the last one is the Capital IQ model. No reason to do a size adjustment. Our revenue, 23 billion. Let's see how that works here. Y'all getting comfortable with using Bloomberg? You just flip back and forth. Look at revenues. So they got revenues at 14. I'm sorry, 19.9. We have 20. We're not that far off. Let me see what year that was. 29. Yeah, we're a little high, but remember this is our bull case. Our bear case is 18, so we're right in line with that forecast. Let's look at EBITDA and just see. So they've got 806 or 8.1. And we have 6.2. So we're actually low on the EBITDA side, even in our bull case. So that doesn't look particularly out of line, and it still looks cheap. So let's look at we're going probably a pretty wild football chart. We'll look at it. Yeah, I mean, this one looks pretty cheap. What did they do that's interesting to you? I know Gilead and Amgen much better than these two. So.
I haven't really like read too much into it. I've been more into the idea one. But this one passed the screening model too.
Company discovers, develops, commercializes farm products for the treatment of serious, that doesn't tell you much. Fully integrated biotech that invents, develops, manufactures, commercializes medicine for people with serious diseases. They don't tell us which one. Inflammatory, cancer, they're kind of all over the place. Let's see if we can. So it's not bad to do company research and just see what comes up that you can do the Bloomberg intelligence. So, just read here. You got a good JP Morgan. Yeah, there's some good articles there. So you got some good articles. You know how to get those articles on Bloomberg. Just read them. So that wouldn't be a bad one for your first pitch because it's a big, solid company, large company, got a lot written about it versus a small biotech. You got a lot of negative numbers. You can't do much valuation. You probably won't have much written on it. And here you have a really good JP Morgan report. And you can
For that one, would that be like okay for like my third one?
the smaller one.
How about like two with some sort of like good history, bigger market caps, and then the third one that
I would wait and do the most difficult one last. Give yourself a chance because this is a class as well as a portfolio. So give yourself a chance to get used to the process and the work. You're gonna have a lot easier time with this firm than you're gonna have with that other one. It's really tough to value firms that have not only no positive earnings, but none forecast for the next 5 years. That's gonna be really tough. But yeah, this interesting firm. I mean, I love Gilead and I like Amgen, but we've done those before, so this gives you another one to look at and see if there's something interesting there.